There is one lever, controlled by 8 people sitting in a room in Ottawa, that simultaneously moves the Canadian stock market, the real estate market, your mortgage payment, your savings account return, corporate profit margins, and the Canadian dollar. That lever is the Bank of Canada's overnight lending rate. Here is how powerful it is. When the Bank of Canada cut its rate from 5.00% to 0.25% between March 2020 and April 2020 in response to the pandemic, Canadian home prices surged 54% over the next 2 years. The TSX recovered from a 37% crash to new all-time highs within 18 months. A typical Toronto homeowner's monthly mortgage payment on a variable rate mortgage fell by hundreds of dollars overnight. When the Bank of Canada raised that same rate from 0.25% back to 5.00% between March 2022 and July 2023, in 10 consecutive hikes, the opposite happened. Home prices fell approximately 20% from their peak. The TSX dropped significantly in 2022. Monthly mortgage payments on variable rate loans rose by hundreds, sometimes thousands, of dollars. The Bank of Canada has since cut rates 9 times, from 5.00% to 2.25% between June 2024 and October 2025. The TSX responded, up 31.63% year over year as of June 1, 2026. One lever, 8 people, both asset classes simultaneously. This video explains exactly how interest rates affect the stock market and real estate, why they move in different ways, what the current 2.25% rate environment means for each, and the 4 specific moves that position any Canadian investor to benefit from where rates go next. Before we explore the effects, every viewer needs to understand the mechanism. Because the Bank of Canada's overnight rate does not directly set your mortgage rate or the stock market, it creates a cascade, and understanding each step of the cascade is what makes the effects predictable. What the overnight rate actually is, the overnight rate is the interest rate at which major Canadian financial institutions borrow and lend one-day funds among themselves. It is the foundation rate, the base cost of money in the Canadian financial system. Every other interest rate in Canada is priced relative to this base. How the cascade works. Step 1. The Bank of Canada raises the overnight rate from 2.25% to 2.50%. Step 2. The prime rate. The rate Canadian banks use as a benchmark for variable mortgages, lines of credit, and some loans, rises in lockstep. The prime rate is typically the overnight rate plus 2.20%. At a 2.25% overnight rate, prime is approximately 4.45%. Step 3. Variable rate mortgages, priced at prime minus a discount, immediately become more expensive. A variable rate mortgage at prime minus 0.90% goes from 3.55% to 3.80% overnight. On a $600,000 mortgage, that 0.25% increase adds approximately $75 per month in interest. Step 4. Fixed mortgage rates, priced off Government of Canada. Bond yields, rather than the overnight rate directly, respond more slowly and sometimes differently. When the BOC raises rates aggressively, bond markets often move ahead of the BOC, meaning fixed rates may already reflect expected hikes before they happen. Step 5. GIC rates and savings account rates rise, making fixed income more attractive relative to equities. Step 6. Corporate borrowing costs rise, affecting profit margins for debt-heavy companies and reducing business investment. Step 7. Consumers with variable rate debt, mortgages, HELOCs, lines of credit, have less disposable income. Spending slows, Economic activity decelerates. The Bank of Canada's dual mandate. The Bank of Canada has one primary mandate: keep inflation close to the 2% target. The overnight rate is its primary tool. When inflation is above target, raise rates to cool demand. When economic growth is too slow, cut rates to stimulate. The entire sequence of rate changes from 2022 to 2025 was driven by: inflation hit 8.1%, raise rates aggressively. Inflation fell to 2.4%, begin cutting rates, support growth. The Bank of Canada rate decisions are one of the most direct policy tools a government has. They flow through the entire economy within months. Understanding them is the foundation of understanding every major asset class move of the last 5 years. Action step. Right now, look up the current Bank of Canada prime rate. Then find the rate on your variable mortgage, HELOC, or line of credit. Calculate how much each 0.25% rate change costs or saves you monthly. That number is your personal sensitivity to rate decisions. Here are the 4 specific mechanisms through which interest rate changes affect stock market valuations, because the relationship is more nuanced than simply rates up, stocks down. Mechanism 1. The discount rate effect. Every stock's value is theoretically the sum of all its future cash flows, discounted back to today using an interest rate. When interest rates rise, the discount rate rises, making those future cash flows worth less in today's dollars. This is why growth stocks, companies whose profits are mostly in the distant future, are hit hardest by rate increases. Their future cash flows are discounted the most. This explains why technology stocks, including Shopify, fell dramatically in 2022 when rates rose aggressively, even though the underlying businesses had not fundamentally changed. Higher rates made their future profits worth less today. When rates fell in 2024 and 2025, tech stocks recovered strongly. Mechanism 2. The bond competition effect. When risk-free Government of Canada bonds yield 5%, investors have less incentive to take the risk of owning equities for a similar or lower expected return. Money flows from stocks to bonds. Stock prices fall to offer higher expected returns that justify the additional risk. When rates fall to 2.25%, bond yields are modest. The risk-free alternative is less attractive. Money flows from bonds back into equities. Stock prices rise to reflect higher demand. This is why the TSX rose 31.63% in the year to June 2026, following 9 rate cuts that made bonds less competitive relative to equities. Mechanism 3. The corporate earnings effect. Higher interest rates increase the cost of borrowing for corporations. Companies with significant debt, real estate investment trusts, utilities, telecoms, pipelines, see their interest expenses rise directly. This compresses profit margins and reduces earnings. Lower earnings mean lower stock valuations. Lower interest rates reduce borrowing costs, expanding profit margins for debt-heavy companies and stimulating the business investment that drives future earnings growth. Mechanism 4. The economic activity effect. Rate changes affect consumer spending and business investment, which ultimately affect corporate revenues. When rates rise, Canadians with variable mortgages and HELOCs have less disposable income. Consumer spending falls. Retail, restaurant, and discretionary companies see revenue pressure. When rates fall, the opposite. More spending capacity, more revenue, better earnings. The 2022 to 2026 stock market. In context, 2022. BOCI raises rates from 0.25% to 4.25% through the year. TSX falls significantly. Growth stocks hardest hit. 2023. Rates peak at 5.00%. TSX recovers modestly. 2024 to 2025. 9 rate cuts. TSX accelerates. June 1st, 2026. TSX at 34,735, up 31.63% year over year. The correlation between rate cuts and equity gains is not coincidental. It is mechanistic. Action step. Look at your portfolio. Identify which holdings are most sensitive to rate changes. Dividend-paying utilities, REITs, and telecoms are most sensitive. Their valuations move almost inversely with interest rates. Technology growth stocks are sensitive through the discount rate mechanism. Banks have a more complex relationship, benefiting from higher rates through net interest margin but hurt by weaker loan demand. Here is where the interest rate effect is most directly felt by most Canadians. Because 67% of Canadian households own their home, and almost all of them used a mortgage to do it. The affordability mechanism, a $600,000 mortgage at different interest rates, produces dramatically different monthly payments. The difference between a 2.0% rate and a 5.25% rate on a $600,000 mortgage is approximately $1,015 per month, $12,180 per year. That is nearly 23% of the median household after-tax income. When rates fall, that monthly saving goes back to the borrower. Demand for housing increases, prices rise. When rates rise, the monthly cost jumps. Qualifying income requirements rise. Fewer buyers can afford the same property. Demand falls. Prices fall or stagnate. The stress test and qualifying rate. The OSFI B20 stress test requires mortgage applicants to qualify at the higher of their actual rate plus 2% or 5.25%. At the current best 5-year fixed rate of approximately 4.47%. The qualifying rate is approximately 6.47%. At $93,000 median household income, this limits purchasing power to approximately $550,000 in mortgage, meaning many buyers are locked out of markets where average prices exceed $700,000. Every 0.25% reduction in rates effectively lowers the qualifying rate and expands the pool of buyers who can access the market, supporting prices. The 2020 to 2022 boom. With the overnight rate at 0.25%, 5-year fixed rates dropped to approximately 1.5% to 2.0%. The affordability of every price point improved dramatically. Demand surged. Supply could not respond. National average prices rose from approximately $530,000 in January 2020 to $816,720 at the February 2022 peak. A 54% increase in 25 months. The 2022 to 2023 correction. Rate hikes pushed the best 5-year fixed rate from approximately 2.0% to 5.5% plus. Qualifying rates rose to 7.5% plus. Buyers were abruptly disqualified from price points they could previously afford. Demand collapsed. National average prices fell approximately 20% from the February 2022 peak by the end of 2022. The 2024 to 2026 rate cut impact on real estate. 9 rate cuts from 5.00% to 2.25% have reduced borrowing costs. The best 5-year fixed rate as of May 2026 is approximately 4.14%. Affordability conditions improved for 9 consecutive quarters, the longest streak on record. But prices remain at historically elevated levels relative to income. The national average is approximately $664,000. still 25% above pre-pandemic. The affordability improvement has been meaningful, but has not restored pre-2020 conditions. Action step. Calculate your mortgage qualification at today's qualifying rate of 6.47% on your household income. Then calculate it at 5.47%, representing a further 1% BOC rate cut. The difference in qualifying mortgage amount tells you exactly how sensitive your local real estate market is to further rate cuts. Most Canadians think about interest rates in terms of mortgages and stocks. Few think about the Canadian dollar, but exchange rates are directly and immediately affected by rate differentials between countries. When Canada's interest rates are higher relative to the U.S., foreign capital flows into Canada to capture the higher yield. Demand for Canadian dollars rises. The CAD appreciates relative to the USD. When Canada's rates fall faster or further than U.S. rates, the yield differential reverses. Capital flows to the U.S. Demand for Canadian dollars falls. The CAD depreciates. In April 2026, the Bank of Canada held its rate at 2.25%, while the Federal Reserve held the U.S. federal funds rate at 4.25% to 4.50%. The Canada-U.S. rate differential was approximately 2.0 to 2.25 percentage points in favor of the U.S. This differential puts downward pressure on the Canadian dollar. A weaker Canadian dollar has several effects. For investors, Canadian investors holding U.S.-denominated assets, including XEQTs, approximately 45% U.S. exposure, benefit from currency translation gains when the CAD weakens. A 5% CAD depreciation adds approximately 5% to the return on U.S. holdings for Canadian investors, in Canadian dollar terms. For importers and consumers, a weaker Canadian dollar makes imported goods more expensive. Since a significant portion of Canadian consumer goods, electronics, vehicles, food categories, are priced in U.S. dollars, Canadian dollar depreciation creates an additional inflationary pressure on Canadian households. For exporters, a weaker Canadian dollar makes Canadian goods cheaper for foreign buyers. Canada's energy, mining, lumber, and agricultural exports become more price competitive when the dollar falls. The Bank of Canada's rate decisions therefore have a global dimension, affecting not just domestic asset prices, but Canada's position in international capital markets and the purchasing power of every Canadian dollar spent on imported goods. Action step. Check the current USD/CAD exchange rate. If you hold XEQT or other global ETFs, a weaker CAD is working in your favor for the US-denominated portion. Factor this into your total return calculation. Here is the most actionable section. Canada is currently at 2.25%, held for 4 consecutive meetings as of April 29, 2026. The OECD projects Canada's GDP strengthening to 1.2% by end of 2026 and 1.7% in 2027. The question every Canadian investor is asking, where do rates go next? The honest answer, nobody knows. Rate forecasting is notoriously unreliable. But here is what we do know. At 2.25%, Canada is in a neutral to modestly stimulative rate environment. The risk is roughly balanced between further cuts if growth disappoints and potential hikes if inflation reaccelerates above target. Here are 4 moves that work in the current environment, regardless of which direction rates go next. Move 1. Lock in fixed mortgage rate. If you are renewing, the current best 5-year fixed rate is approximately 4.14% to 4.47% depending on lender and date. Variable rates are approximately prime minus a discount, currently around 3.55% to 3.85%. If rates fall further, variable wins. If rates rise or stay flat, fixed wins. At current levels, the fixed rate provides certainty that most Canadians with stretched budgets will find valuable. The 2022 to 2023 experience showed how quickly variable rate costs can escalate. For Canadians whose budget cannot absorb a 1% to 2% rate increase, the fixed-rate insurance premium is worth paying. Move 2. Hold rate-sensitive equities in the current rate environment. REITs, utilities, telecoms, and pipelines are most sensitive to rate cuts. Their valuations rise as rates fall. If rates decline further, these sectors outperform. VDY and XEI hold significant exposure to financials, which benefit from economic growth, and energy, supported by rising oil prices. For pure rate cut exposure, a Canadian REIT ETF like ZRE or VRE provides concentrated exposure to the asset class most directly boosted by lower borrowing costs. Move 3. Use the FHSA if buying in a rate-sensitive market. If you are planning to buy a home, the current rate environment is more supportive than the 5.00% peak. The FHSA builds your tax-free down payment, $8,000 per year, $40,000 lifetime, while the rate environment continues to improve affordability. Every year of FHSA contributions is both a tax deduction today and a tax-free withdrawal when you buy. Move 4. Extend RRSP/TFSA, duration toward equities, not fixed income, at 2.25%. GIC rates have fallen significantly from the 2023 peaks of 5% plus. The best one-year GIC is approximately 3.85% in 2026. With CPI at 2.4%, the real return is approximately 1.45%. Equities, with historical returns of 8% to 10% annually, remain substantially more attractive for long-term wealth building. The 2023 case for holding GICs at 5% plus was genuinely compelling. The 2026 case at 3.85% is substantially weaker for long-term investors. TFSA room should be prioritized for equity, ETFs, XEQT, VDY, over GICs in the current environment. Action step. Review every fixed income position you hold. Calculate the current real return, yield minus 2.4% inflation. If below 2%, consider whether redeployment into equity, ETFs inside the TFSA, is appropriate for your time horizon and risk tolerance. Let's come back to where we started. One lever, 8 people, both asset classes, simultaneously. The Bank of Canada's overnight rate went from 0.25% in April 2020 to 5.00% in July 2023 to 2.25% in October 2025. Held at 2.25% through April 2026. Every major move in that sequence left a visible mark on the stock market, real estate, and the Canadian dollar. Rates at 0.25%. Home prices surged 54%. TSX recovered from pandemic crash to all-time highs. Savings accounts paid almost nothing. GICs were unattractive. Rates at 5.00%. Home prices corrected 20%. TSX fell significantly in 2022. Savings accounts and GICs briefly became genuinely competitive. Variable mortgage payments soared. The technical recession of Q4 2025 and Q1 2026 was partly the consequence of the rate hike cycle's full effect flowing through the economy. Rates at 2.25%. TSX up 31.63% year over year. Affordability improving for 9 consecutive quarters. GIC rates declining from their peaks. Equities increasingly attractive relative to fixed income. The four moves for this environment: consider locking in the fixed mortgage rate, position in rate-sensitive equity sectors, maximize the FHSA for the improving home buying environment, and prioritize equity ETFs over GICs in the TFSA. Understanding interest rates is not just about being informed. It is about making better financial decisions. About when to fix your mortgage, which sectors to weight more heavily, when GICs make sense versus equities, and how to read the global rate differential for its effect on your portfolio's currency exposure. The lever is always moving. Now you know what it moves and how to position around it. If this video made the interest rate mechanism finally clear, subscribe. New Canadian personal finance content every week. Drop a comment. Are you on a fixed or variable mortgage? And how has the rate cycle affected your finances?